5 seconds to go, and the first rates will just start come up on your screen. I'm going to let my Bloomberg screen do all the talking. Just bear with me. There you go, the first rates any second now. Nifty is off to a flat start, Sensex is off to a negative start. Nothing in the mid-cap space is also looking anything exciting at all. Let me just first spot the real volume movers here. You got Prince Pipes, 7%, 4% higher for, now it's subsiding. Prince Pipe must have seen a block deal, now it's come down. You got Adani Power, which is up by 4%. You got Precall, which is up by 4.5%. Yes Bank is not going anywhere, Zomato is not going anywhere, Punjab National Bank is not going anywhere. So nothing in terms of large volume gainers which I can identify for you. Now let's look at some of the value dominated stocks. Reliance flat start, IndusInd Bank flat start, Nestle flat start, Tech Mahindra is relatively reversing, and Adani Port is the only one, Adani Power is the only one which I can identify as a stock where the price action and the volume action right now is looking decent. Aisha?
Just looking at some of the other buzzers in trade, and more importantly the newsmakers. I want to see what Precall is up to, what Minda Corp is up to. Both those stocks will just come up for you on your screens, because while we've not heard the side of the story from Minda Corp, it seems that they were looking to buy a sizable stake in Precall via the open market, and one part of the block deal has already happened. Minda Corp holding up 5.5% in trade. Let's see what Precall as well is up to and where it's settling in at. A lot of telecom data coming out, and Jio has increased the monthly subscribers quite a fair bit. In fact, they currently stand at 17.8 lakh subscribers, and this is the November data that I'm talking about. Vodafone, of course, has lost about subscribers once again. The December loss stands at 24.7 lakh subscribers, and by the way, for 21 consecutive months, Vodafone Idea subscription levels or subscriber count has only been decreasing. Vodafone Idea down about 0.6%, and Bharti has added more than 15 lakh subscribers in the month of December as against to the 10.56 lakhs which it stood at in the month of November. So these are a couple of stocks which are in focus. RailTel once again has bagged an order from the Bangalore Metro Rail Corporation. Schaeffler India came out with its numbers. The EBITDA is up almost over 20%, margin uptick of about 40 basis points. There's of course HAL and Bharat Forge as well, in now an MOU with Defence Ministry for development and production of aero steel alloys. So look out for this space. In fact, HAL, BEL, the entire defence pack was on a tear yesterday, and this entire pack continues to hold a buzz even today as we speak. Let's see what HDFC is up to. That sizable bond issuance we've been talking about. We heard from KK Mistry as well on that same. 0.5% lower is where HDFC has started off in trade. And now, of course, I want to check in on the big move that you had in ONGC yesterday, or for that matter, what we've been seeing on TechM for the last two trading sessions. TechM, remember, has put on almost about 11% in the last two trading sessions. Today, it takes a bit of a pause, 1.25% lower for TechM as we speak. For the Nifty, yes, we've gone back to sub that 18K mark, but Kunal, it's a less than 0.5% downtick at a time when you had an over 1% fall for US equities across the board. This is not bad.
Yeah, it's not bad. Even the list of stocks which I was actually looking at, there's hardly any major percentage cut into these names. And I'm talking of the names which have been showing good price action for themselves over the last couple of days, which means that it's not an immediate withdrawal of positions or unwinding of positions into these stocks. Traders are still watchful. They would probably expect that maybe the first couple of hours of the market settle off, then they would probably build on to the positions and the gains which the stocks have shown the last couple of days. The stock which I would look to trade in the opening would be from the mid-cap IT names. First Source Solution, I think, is something which looks very attractive on the charts. 118.19 is where the stock is trading right now. Looks attractive for a potential near-term target of 128 plus.
All right, watch out for 128 plus on First Source Solutions. Jay, looking at the screen right now, the fact that it's a measured fall in comparison to what's happening across the rest of the globe, your first trade?
Well, see, in this, fall or in this dip, I would say that one could be eyeing to buy TVS Motors. The stock has provided a very nice breakout from a falling channel since past couple of trading sessions. We have seen a good long build-up happening here as well, and I think it's just the retest of the breakout level that's been happening here. So I think on the upside, we are expecting around the levels of 1160 to 1180, at least in this Feb expiry. So for a week from here on, for the expiry, I would say that TVS Motors can be bought at these levels. And on the lower side, I think that 1070, 75 is a very crucial support range. And till the stock is holding on to those support levels, the probability of a bounce back and further uptrend in this stock is quite high.
Pratik Agrawal joins us now. Let's take our conversation forward. Pratik, good morning. Thank you for joining us. Pratik, this year has been a hard year in terms of news and in terms of the global macro setup. FIs have been selling. There's Adani sell-off fiasco. Markets are trying to digest that what's coming next. But are you somewhere surprised that despite avalanche of news and avalanche of bad news, markets are still firm? We are still 1 or 2% down for the year.
No, so I think that's been our view. From my previous organization till here, the base case was that 18 and a half time 1 year forward earnings is where we should end. Now, after this result season, also, the earnings for next year on the Nifty continues to be closer to 1,000 versus closer to 950. And that would put the fair value for the index between 18 and a half thousand. So I think we are close to there. I think we will end somewhere in that region, and then going forward in the new year, one should again expect earnings growth kind of returns. So yes, there will be noise, there will be volatility, there will be global tightening, there will be global interest rates increases more than what people expect. But in the end, earnings growth, money supply primarily from Indian investors is what will hold the markets well.
Let's understand the concern now, and the concern is that inflation is having an impact on consumption. Pizza companies are saying we are selling less pizza. Zomato is saying that delivery is slowing down. White good companies are saying that AC, fridge, TV, toaster nahi bik raha hai. Are markets factoring that in, that a slowdown already has come in on the consumer end?
Yeah, I think so. So if you look at the stock prices of the pack that you just mentioned, they have seen a sharp cut. Now, here let me share a view that for a very long time, Indian economy was led by consumption. Now, the thesis going forward is that manufacturing capex will be a probably stronger engine of growth over the next few years. I mean, ultimately, people are talking of manufacturing as a percentage of GDP expanding. So, and it is shown in this quarter number as well. Practically, the whole of the capital goods pack has delivered very strong numbers. And people are talking of strength continuing deeper into the future as well. So we are no longer only consumption driven. So yes, consumption is slowing down, but the other parts are doing well. And second, on consumption, there is something which is happening. We understand this has been a K-shaped recovery. So one section has done very well, the other section has not. Now the section that has done very well was probably, ordering food at home before, and now is maybe going out and having food. The same guys can't do both, and that is probably resulting in some sense of slowdown also, till the well-being spreads to a larger section of the society, which again I expect will happen in the next fiscal. So the economy, as it strengthens, is now the growth is touching a wider section of the population, and I would be hopeful on consumption as well in the second half.
So by that premise, Pratik, besides cap goods, where is it that you find comfort enough to buy even at these levels, or perhaps even add to the current positions?
So lots of spaces. Apex, I mean, we spoke on that, so that continues. Defense, if you see as part of Capex, I think that story continues. Banks, versus earlier when people thought we are at peak numbers and it's a 1 quarter thing, and then we will see lower margins, higher credit cost, etc. Now I think banks are saying that the peak is probably 2-3 quarters away. So that space has corrected a bit, should be more investable to my mind. Similarly, chemicals, not all. So it's a very large pack, but the larger names where entry barriers exist, are the names to look at. For some of them, actually, the future is rosier. So I think of the themes which were there, consumption, where both the problems were there, slowing demand and high valuations, is the pack that's corrected. Now, autos, for a long time, there were concerns on transitioning to EV and then hydrogen, and the capex intensity in the interim, etc., new winners emerging. Now, I think every large company has shared the EV plans, so it is not like people are fighting which technology will win and positioning. Now people are rolling out all platforms, both on the two-wheeler side and on the auto side. So I think the space benefits from very strong margin uptick because of lower commodity input prices. So I think that again is a space where concerns were there, they are receding, and the tailwinds are probably again emerging.
So tell us a bit about what you're buying and selling. I'll keep the next question very simple.
No, so let me tell you what we did as a house was to sit together and identify narrow themes. Okay. So in terms of differentiation, we still believe in lending, we need to be with banks, but maybe incrementally some money should go into NBFCs as well. We had a defense allocation for the whole house. In China Plus One, we thought chemicals are probably a better way of investing there. In healthcare, we actually thought hospitals are a better way of investing versus the branded generic or generic businesses. In technology, while bulk of the allocation is still services, we are underweight technology, but not by much. We are saying that the new age tech companies are now de facto good businesses, good valuations, weak hands. So we are starting to definitely nibble there. So that gives you a sense. So as a house, you will see all of our funds now being positioned in these spaces.
Morning, what's your take when it comes to the China Plus One factor? Which sectors do you believe that this could aid?
So textiles are benefiting from that, but textiles has a larger commodity influence. I think chemicals has been my personal go-to sector on China Plus One for a very, very long time. A very long runway of growth with good margins and good sustained ROCs. Otherwise, the PLI scheme beneficiaries are also beneficiaries of China Plus One. So there is a combination of China Plus One and PLI. But there's, one, there are too many companies coming in. Two, one is not sure of the entry barriers. It's more to do with who one is able to partner and so on. So that is receding in the order of preference, frankly.
Okay, in the meantime, wanted to also get in just your opinion on new age tech, given the fact that we have seen some of these companies as well bounce back. Just a quick take here, Prateek.
No, so I mentioned that, we believe many of these companies are great businesses, good valuations, weak owners. So ownership changes is what will cause volatility in the stock price. So, one should size the positions well, but at the same time, good times to look into that space. many of the brands there may be stronger than the strongest of the brands we know of. So the new age companies, within a moment, what can one think of? Well, those brands are stronger than any other brand in the country. Many of these are now, one player, two player, three player kind of businesses. So in the marketplace also, while there can be theoretically disruption, but as of now, it's a very, very strong position that some of these winners have in the marketplace. And the path to profitability is being shared by practically everybody. So it's no longer that I made a loss of $100 last year and this year I will do 200 and the next year I will do 300. The story is now changed to, yeah, I made a loss of 200. Now next year, probably I will get to EBITDA break even, and the year after maybe PAT break even. So that is what is interesting. And many of these are PE sponsored, all of them are PE sponsored businesses.
Right.
Now it will start to make sense if the losses
Right.
of the past somehow replicate into profits of the future.
Sure. Thanks very much, Prateek, for taking time out and joining in and giving us your view on the markets. Let's hear it out from market veteran then, Ramesh Zamani, who says that India's bull market is intact and we are the only nation that can compete with China in terms of manufacturing. He's bullish on defense, railway PSUs, and companies that manage data efficiently.
Because I'll tell you the two new sectors that we've been trying to bet on. Some you may be familiar with. Data, as everyone keeps telling you, Nikunj, is the new oil. I mean, that's now a well-known fact out there. Now, data has a lot of components. You've got to aggregate it, you've got to analyze it, you've got to put intelligence out of it. Now, if you look at the companies in India that do specialize in data, I think their employee cost as a percentage of revenues is between 60 and 70%, which tells me two things, that this business is coming to India, because if India is paying 70% in salary cost for this business, it's clearly a business that cannot be done in America or London or Germany. It has to move to India. So there are a lot of new companies in there that are using data either to aggregate it in a database or ship it out in intelligent forms. So I think the first sector of new ideas, if you wish, is we're looking at those set of companies, because we believe that the cost basis of that business also almost ensures, given that we have now good telecommunication and cheap property prices, that the business will shift to India. The second business, which as you know, I've been bullish on the last few years, is particularly some of the defense and railway PSUs. And given the government's capex push in railways particularly, I think there's some very cheap stocks, I'll use that word advisedly, cheap stocks in the railway space. And if you notice the last few days, there's been a lot of noise of India becoming an export powerhouse in the defense sector. Now, if India is going to be an export powerhouse on defense, $5 billion is the number bandied around next year. I think a couple of listed companies which will have to benefit dramatically from that push. So I would say you go for data, and then I would still stick to some of the cheaper defense and rail PSUs, particularly because of the capex and export push that they're experiencing.
But are these businesses, especially the defense stroke railway businesses, are these high quality businesses? Because the top line may be great and the government commitment towards defense and railways is strong, but some would argue back and say that these are not the best of the businesses when it comes to return ratios.
Well, I disagree with that. I mean, I'll give you an example of a company that I still own, and I'm only saying it as an example, not for anyone to buy it or anything like that. So please be very careful. You remember, Nikunj, in the early 2000s, we used to buy a company called Bharat Electronics, which I own today also, but I'm not recommending it. I'm just saying that the stock from those lows, it was a 300 crore market cap, it's now 60,000 crore market cap. So over the years, it's compounded for investors, paid a very rich dividend yield. So I get very a bit upset with people who trash, throw the baby out of the bathwater. It is your job as an analyst to find the good from the bad, the good PSUs from the bad PSUs. Don't necessarily look at the resource-rich PSUs or the telecom PSUs, but others look at, just like you can fail in the public, in the private sector enterprises, so many businesses in private sectors have failed miserably. So in PSU, and the aggregate of taking all the PSUs in one basket and looking at the returns of 10 years is misnomer, because you're comparing apples and oranges. So you look at defense PSU separately, railways PSU separately, commodity PSU separately, and then you'll start making more intelligent decisions. So I completely and totally disagree that the return ratios are bad. In fact, some of these dividend payouts, return on capital, cash flow yields, corporate governance matches that I have seen in some of the better private sector companies. And at the end of the day, you're making money in them. I mean, that's always the test in the stock market, that are you making sustainable money in them? Because they're paying you dividends and they are, generating cash flow. And I think they are. So, I'm happy, if people are ignoring it, that's okay. It gives me an opportunity to buy these stocks cheaper, which I am. But, we're not necessarily very to PSU. We're very to good PSUs that are delivering for the shareholders. And we have lots of private sector companies. So if you're not comfortable, all means go ahead with the private sector companies. But if you're an analyst sitting in Bombay and trying to figure out cheapness and value and growth and prospects, I don't see how you can ignore that basket.
Mr. Damani, you've always, in a sense, emphasized the importance of mean reversion and market cyclicality. There are phases in the market where dividend yielding stocks have done well. There are phases in the market where growth stocks have done well. There was a phase in the market where infrastructure and commodity stocks did well. So for next 3 to 5 years, what phase of the market we are in, and what is the template which will work for an investor?
Again, the first template we believe, Nikunj, is that we are still in a bull market. That's very important of how you position yourself. We think the bull market will be driven by demographics and by India's geography. So any companies that can benefit from that, maybe it's inward-facing companies, maybe it's companies catering to population bulge, housing finance, or anything else. And these data companies are, of course, export-facing, but we still think there's a value proposition there. So I think having gone through the first 2 layers of understanding that we are in a bull market, we believe that Indian equities will do well, not over the next 6 months or 12 months, because there's no idea how they'll do. But over the next 5 to 10 years, I'm fairly confident that they'll give you a good compounded rate of return. I would invest in those businesses that profit from the demographic bulge that you're facing, from the manufacturing impetus that you're facing, from the service sector that we're still very good at. And, the firm belief that if India is to now compete in the world, it needs to match China in terms of economic heft. So once you kind of understand that, I think it's much easier to find stocks that fit those criteria than, just being influenced by the price of the market going down for 2 weeks or 3 weeks.
Mr. Damani, when we met last time, we spoke about fintech and consumer tech, and you said that, look, you like the power of some of these businesses because they represent the new way how the demand and the societal needs would change, but you were not very happy with the valuations. Guess what? From euphoria same time last year, couple of months ago, there was fear. Have things normalized for the consumer tech and fintech stocks?
I think they have, Nikunj. I think they have. I mean, if you look at the numbers first, all the fintechs and the consumer tech companies report a very strong sales growth, but still profit is eluding them. How good is the sales growth? I mean, if you look at the quarterly numbers, at least, and divided by about, I would say 90%, about 600 million people are their addressable market. The per capita consumption of a food delivery company per quarter, or the per capita consumption insurance company is like 10 or 20 rupees per quarter. So it's very, very low. And I think given the fact that India is going to add 250 million people in the next 30 years, 95% of those people will have access to a smartphone and will access to cheap data. And they've been born post-92, so they're post-liberalization children. And they only know the technology and internet. They're not used to long lines, ration queues, and things like that. So they will be eager beavers, in a manner of speaking, to enter into the fintech and consumer tech space, if you will. So once you look for, then the universe narrows. And I think they're ultimately good businesses, whether it's the food delivery business or the insurance business. They're good businesses. They just came at an extremely incoherent valuation. The market has corrected that. I think if you start looking now more sharply, you will find value in the new tech businesses. And again, I would not try and look for a path to profitability next quarter or next 6 months. But as long as the sales growth remains strong and they have enough money to burn to last them till the profit comes, I think they'll be okay. So my advice is that an initial exposure to these new tech companies is probably warranted.
Right. We are looking at a very big change in the macro regime, which is that from an era of low interest rates and low inflation, we are now moving to a normalization of interest rates and high inflation. How will that change the investment template?
Well, that used to be the fear. I think that 40 years we had a bull market based on low interest rate, full employment, globalization, and the parameters of that have changed now. So we're going to have deglobalization, higher interest rates. My feeling is that I'm not convinced that inflation is headed to a higher plateau. Yes, it's been sticky and it's been bad. Let's take it India and the US, or India and the West, if you will, just to understand what happens. India we've dealt with high inflation the last 40 years, and it tends to be sticky from a period of time. But India is primarily building a new economy, and the new economy, doesn't require a lot of the old amounts of capex expenditure or the old type of inflationary expenditure that takes place, because you need copper, steel, concrete, and a few computers, and often running for business. So I think we will see inflation from time to time, but it won't be as severe as it was in the 70s or 80s. Now, let's go overseas. If you go and see the new factories that Tesla is building, or Amazon is building, or any of the great companies in America building, they're being staffed by robots. And robots, Nikunj, as you know, work 24/7. So they're 3 times more productive as a normal human being. In fact, in America, you can't find people for a lot of jobs. So if you find that robots, which are cheaper and more productive than human beings, are replacing the human capital cycle, it points to deflation, because you have productivity growth and you have lower employee costs. It doesn't point to inflation. So I think that, we went through a bad phase because we actually pumped up the economy too much in the Western world, and that led to high inflation. But I think beginning next year, inflation will moderate to around 2 to 3% levels. And I think my sense is the fears of high inflation trajectory are probably misplaced.
Okay, that's the word coming in from Ramesh Damani. Let's quickly see where, the markets have settled in at, and mildly lower. In fact, for the Nifty futures, we are still at that 18K mark. Ipca Labs, Nestle, LTTS, Idea, FSL are some of your rank underperformers. Cement as a pack is the one which is seeing a fair amount of traction. So India Cement up nearly 2%, Ramco is holding up, JK Cement is up 2.5%, and so is Ultratech Cement. It's cement all the way, which is the one big winner. But here's our exclusive chat with the top newsmaker of the day, and that's got to be pre-call. The MD Vikram Mohan told us that they do not know anything about the Minda Corp stake buy.
It's come as a surprise to us as well. The promoters stand absolutely committed to the business. We have turned around the business. We are on a very, very strong financial footing. We are long-term debt-free. We have technologies in place. We have signed in the recent past technology agreements with 3 class-leading companies globally, 2 from Europe and 1 from Silicon Valley, to position our products out there. We are generating substantial cash profits, which will fund our expansion plans. I've been constantly talking about our expansion plans and how we intend to double our turnover in the coming years. Our PLI application has been accepted by the ministry as well. So I don't know where this baseless information is coming from now.
So, Mr. Mohan, if let's say Minda goes ahead with a secondary book building offer of 15.7% stake, and where the promoters of Precall are not looking at selling or participating in any open market transaction, then it is an hostile takeover attempt.
It is not a hostile takeover attempt, if I may say so, because I have spoken ever since this news broke to certain sections of the institutional investors who are all very, very strongly backing us at this point in time. So I don't see how it could be a hostile takeover attempt. Secondly, our share price closed at 209 yesterday, I don't see any reason why shareholders will sell at 209 at the current market price.
But that's exactly the point, Vikram, because it's a sizable block deal, right? Almost 4.2 to 4.3% equity has changed hands on the exchanges. So what's the next game plan now? Any firefighting, any ammo that you would have in case, this turns out to be a hostile takeover? Who bought, who sold, that we'll only come to know later this evening?
We are working with our investment managers and our internal armory to see what else we can do, because I think it's a little early in the day right now. But we stand committed to this business, and that's all that I can say. And we will not allow a hostile takeover. We will have our counter offers, if necessary, at the right time.
What is the current ownership of the promoters, sir, in the company?
It's 37%.
Okay.
It's 37%.
Would you be looking at increasing your stake from the open market operations?
Not at this point in time. I wouldn't like to comment on that.
Do you have any existing business relationship with Minda, or this is more like a bolt out of the blue suddenly coming out which you were not aware of?
This is a complete bolt out of the blue that I was not aware of. We have absolutely no business association with Minda. In fact, they are our competitors.
All right, just revisiting that conversation that we had with the management of Precall. As of now, the shares are down about 0.5% or so. But let's get a move on then. And UCO Bank is in the news, largely on the back of numbers where the profits have surged. There's been an exceptional interest recovery. And let's find out a little bit more about their loan growth as well as deposit trajectory. Soma Sankara Prasad is MD and CEO at UCO Bank and now joins in on the show. Thank you so much for taking time out. Now, just let's look at your deposits this time around, because that seems to be a bit of an issue. What is your outlook for the calendar year 2023? Will it be the year of deposit mobilization?
Yeah, see, if you look at the deposit side, what has now happened is that most of the banks have increased their deposit rates. And with the inflation, of course, there has been a spike recently, but for that factor, inflation had gone below 6%, and we are offering about 7.5% to 8% on the deposit side. So the depositors are getting a real return on their deposits for the last few months. I think a lot of depositors who would have gone to the other sectors earlier because they were getting a negative return on the bank deposits would come back to bank deposits. So I would see that in the next 1 year, maybe the deposit growth will certainly pick up in the banks.
And will this growth come at the cost of NIMs, however? Because your NIMs are now at 3%. What is your trend or guidance going forward for, say, the fourth quarter or the full year?
See, if you look at the NIMs, generally what happens is that on the advances side, the entire portfolio gets repriced whenever there is an increase in repo. But on the deposit side, it is only the incremental deposits which get repriced, or the incremental deposits we have to pay a higher rate of interest. So, I mean, to that extent, at least, I mean, the impact would not be there on the NIMs. But having said that, I think that with the deposit rates going up, it will have an impact on the NIMs to a certain extent. But you'll have to also see that with the recent repo rate hike, the MCLR as well as the repo rate, what we charge to the borrowers has gone up. So the impact on NIMs would be there because there has been an increase in the deposit rates, but it would be very limited.
What we have are the numbers for the quarter gone by, and quarter gone by for most of the banks was solid, including yours. But now we understand that slowdown has started. The exception of corporate book, the retail book is slowing down. Auto sales are slowing down. Low-cost housing is taking it easy. Are you feeling any early signs or any wrinkle or a tremor of slowdown?
We don't find any signs of slowdown on the retail side so far. Because, see, we have ended the third quarter, our home loans have grown by about 19%, the car loans have grown by 19%, the personal loans have grown by 23%. And going forward, I would tend to believe that the inflation would definitely moderate in spite of the recent spike, which I would see only as a blip. So going forward with the inflation moderating and with the government's capex spend having its impact on the downstream, I mean the other sectors, I don't think there would be a slowdown as far as the retail loans are concerned, or even on the corporate side.
How long this gap between the credit growth and the deposit growth is manageable? There would be a point in time at which either you will be forced to raise capital or you would be forced to increase your deposit rates.
Yeah, that is true. But generally, see, I think one point which we should, I should point out is that during the COVID time, there was an accretion only on the deposit side, and there was hardly any growth in the advances side, with the result that we had a lot of liquidity going into this loan growth. So when we look at the deposit growth of 10 to 11%, I think we should remember that this is on a higher base. Compared to the loan side, because the loan growth was muted, and therefore in percentage terms the loan growth looks large. But if you look at the absolute figures of deposits and advances for the entire banking sector, they are more or less equal into each other, because the deposit base is much bigger as compared to the loan base. But having said that, as you said, all the banks have taken steps to ensure that the deposit growth picks up. Because now the liquidity has become a little tighter, especially in this quarter. So I think you must have seen all banks raising their deposit rates. So I think in course of time, I think the deposit growth would also pick up. And I don't think I foresee any kind of a problem wherein, the banks would be facing an issue when it comes to the loan growth.
To Adani Group of companies, I have to ask this mandatory question just to understand.
Yeah. See, the Adani Group of companies, our exposure is less than 1% of our loan book. And whatever exposure we have is to assets which are already completed and where there are, underlying cash flows. So there's no concern. Actually, when it comes to this question, which of course you said is the mandatory question that we are asking, our lending is only based on underlying assets, which are infrastructure assets, which are generating good cash flows, and the financial closure has happened, and the projects have been completed. So see, whatever happens on the share price side, but as far as the assets are concerned, there is no issue, because we see very strong cash flows from these assets, and I don't foresee any problem when it comes to repayment.
Would you be open to giving Adani Group of companies more loans? Because if your loan is less than 1%, that means you're way below the ceiling limit. And if you're so confident about financing against collateral and assets, would you be looking at topping up if there is a need?
See, what we'll have to see is we'll have to look at the project. See, in the project, there is a mix of debt and equity, and banks tend to release their debt only after the financial closure has happened. And on the infrastructure side, we find that there is a strong demand in India, and I think the government emphasis has also been on infrastructure. So if the underlying project is good and there is strong demand, and we see good cash flows and the financial closure happens, I don't see any reason why we should not be looking at those assets.
No, but my question was that right now the group is in middle of refinancing, and we are getting mixed signals from other PSU lenders also. So if I may ask you a direct question, that since your exposure to Adani Group of companies is way below the permissible limit, would you be looking at increasing more loan to the existing assets if there is a loan transfer, if there is a repayment requirement, if there is a working capital requirement on all accounts?
Okay, fine. See, there is no request as such, but if there is a request, and if the request is supported by if you find that the underlying cash flows are there to take care of my increased exposure, there's no reason why I should not be looking at it, because we look at it purely from the commercial point of view, whether the loan that I give can be serviced by the cash flows from these assets. So as long as the underlying cash flows are there, there's no reason why I should not be looking at it.
Okay, thank you so much then for taking the time out and joining in. Good to have you today on ET Now.
Thank you.
Mr. Prasad. Good speaking with you. We're going to take a very quick break on that note with news that we're just mildly soft. We're not really acting as badly as our US or, for that matter, Asia counterparts. Cement continues to be the story today. Of course, Reliance is well pushing higher by 0.5%. So is L&T.